Hi, guys. It's Chad Larson with MLD Wealth. This is Money Matters for November 2023. Lots to go through. I'm going to jump around. I got charts in my hands, ideas in my mind, pain in my heart, and aspirations on my shoulders. Couple kind of things to start to. I read an interesting quote. It's from The Psychology of Money by Morgan Housel. Your success as an investor will be determined by how you respond to punctuated moments of terror, not the years spent on cruise control. We're entering this weird period where after a dismal 2022, I reflect on my comments from January at the start of this year, whereby we thought we would have a very choppy market going in the front half of 2023, followed by into the end of this year, basically the time I'm sitting here speaking to you today, that we would see the market start to discount the eventual recovery we see in 2024. And what we meant by that, and what we continue to mean by that, is eventually the markets would become more robust as they started to move towards easing. I even called that we could potentially even have a rate cut by now. The Fed just announced a couple hours ago they're holding flat. And that generally bodes well for equity markets. But speaking back to the things between the known unknown and the unknown knowns, we have to kind of unpack a few things of where we see the world. And I did set the tone a little bit negative a couple of weeks ago with respect to kind of a market update, given things that were going on geopolitically over in the Middle East. But at the end of the day, as we continue to hold an elevated weights of cash, but back off of a soft 2022, this market has been defined as, again, as I've spoken to, as a very narrow market where, 7 stocks, the Magnificent Seven, as they're called now, make up 30% of the S&P 500. And they started reporting this week. Microsoft did incredibly well. Google softened, lowered expectations. Tesla fell by 20%. But so we're starting to see some shakiness even at the top. These Apple, Microsoft, Google, Amazon, Nvidia, Facebook, and Tesla, they've driven the whole market. The S&P 493, it's down, but it's cheap. Making valuations starting to look attractive. But again, not being able to fight the Fed, we are still continuing to look for the Fed to be accommodating. And yet I don't see Jerome Powell taking his foot off. He's taken his foot off the gas, so to speak, on hikes, but I don't think he's about to do a U-turn on policy. Now, if you remember, this is the same gentleman that got up and said inflation was transitory, and an army and slew of memes were created that will echo in the halls of Wall Street chat rooms for all of eternity. I don't think he wants to do this wrong the other way. So I think we're in the lower for a longer camp. And what does that mean? Now, the U.S. economy has remained incredibly resilient. And history, as it's been said, may not repeat, but it often rhymes, making it worthwhile, if imperfect, guide for understanding the economic cycle and its impact on risk assets. And the historical playbook has strongly implied for much of 2023 that the U.S. recession is just likely around the corner. The Fed has tightened monetary policy significantly over the last 18 months. The yield curve is deeply inverted, and leading indicators continue to flash warnings. Historically, this has been a toxic combination, but so far, in the face of historic precedents and ominous signals, the U.S. economy remains strong. I've got a chart here in front of me, and people say, why? Why is it so strong? I don't know if I could find it now, that would be super helpful. But the amount of stimulus that poured into the market comparatively to other developed countries. And this is kind of where I set the table of where some of our concerns are, but potentially where some of our opportunities. When we look at the federal climate spending and front loading of CapEx, remember GDP is made up of government spending as well. Between 2022 through to 2027, we have $80 billion of stimulus being poured into the U.S. market. That's the Infrastructure Investments and Jobs Act, that's CHIPS and the Science Act, and that's the Inflation Reduction Act. That amount of spending has kept the U.S. economy booming. Labor market remains incredibly resilient, and you typically don't see, so the U.S. is like largely avoiding this recession. The problem is that other central banks are following the monetary policy of the U.S., but haven't created the amount of stimulus. Um, the U.S. consumer or any consumer drives the economy, and albeit we've seen the fastest, steepest hike to interest rates, U.S. consumers are less sensitive to interest rate hikes. Looking at a chart below me, it's around 15% of people in the U.S. Are on loans with floating rate mortgages. Comparatively, that is the smallest amount of any other developed country. The U.S. consumer is not feeling what we're feeling here in Canada. So housing prices increased from pre-COVID levels. The U.S. had a housing boom, and no one's feeling it on the affordability index, so to speak. That is not sustainable here up in Canada, and that is going to cause some of the concerns and call out those known unknowns. So labor market remaining resilient. We talked about the fiscal support of the U.S. economy with all the stimulus. Now, if and when, and I always said the cause for pivot will be when the Fed becomes accommodating, and that becomes very bullish for equities. It's just not there yet. So the good, the bad, the ugly, kind of stripping things apart. The average stock is not expensive. When you look at the top median trailing price to earnings ratio of the market, take that away from the Magnificent Seven, markets are a little bit cheaper. But remember, those stocks went up on average 90% this year. No one owned 40% of their accounts in these. Well, I didn't. But remember, these are also stocks that were down by over 50% last year. Down 50, up 90. That's just a wild ride. Talking about kind of global trends of where we see things kind of in a place is, back to kind of what those historical precedents is around the consumer. So yes, the consumers in the U.S. is exhibiting tremendous resilience. Corporate bankruptcies remain low. The fiscal policy of aiding GDP. This historic economic playbook for a recession may not ultimately be denied, but it certainly has been delayed. But unfortunately, the surprising U.S. economic strength is a problem for the rest of the world. Global central banks have been mirroring Fed policy, yet their countries like ours are generally far more rate sensitive than the US, whether it's China, Europe, or Canada. Economic weakness is being pronounced. Add a Fed that's committed to staying tighter for longer, and it's a potential recipe for an even stronger US dollar. The last thing a weakening global economy needs as far as equities are concerned. So we believe stock markets are grinding their way through a longer term trading range, and at the very least will likely continue to adjust to higher rates. At current levels, we're still recommending waiting for better opportunities to emerge. Not saying we're letting grass grow under our feet. We've deployed significant capital over the last month, even into select opportunities that have presented themselves with, I think, once in cycle like return profiles. But at the worst, there's a potential for an accident. If the Fed stays tight too long, especially if the US dollar breaks out, history is replete with examples of a surging greenback acting as a wrecking ball, and we fear this time may be no exception, especially given the current step up for equities. Trends and thematics. One of the pivots in we look at like in a tactical positioning. We're not pausing, but we're adding duration to kind of our call on base metals, and especially that for copper. I'm still fundamentally structurally interested and positioned, but might even pull the trades back a little bit and create more liquidity. Just that trade is only going to work when we see strong GDP growth. It's just not going to be there for a while. But last week's or a couple weeks ago discussion, deglobalization is going to boon well for select economies and sectors. With conflicts, with the creating of a multipolar world. And domesticating, other forms of supply chain, that is going to be a boon for manufacturing, industrials. So that's going to be a net positive. Robotics and AI continue to, obviously they've driven the market incredibly forward, but the advancements, efficiencies, and productivity is going to continue to shape and drive earnings growth for a number of sectors. It's not just weird companies that we don't know what they do. It's going to be the integration of processes, time flow management, inventory management that will create more efficiencies. The U.S. economy, the U.S. labor has more revenue per producing labor than anywhere in the world, and is only going to be augmented by the introduction of AI and robotics. We saw the Industrial Revolution and what that did to create productivity and wealth and in quality of life. That is going to happen, continue to happen. Sustainability is going to continue to be thematically important. I don't think so much by forced policy, but just by people trying to do better and be more educated. And then a big subsector is health and wellness. We have the largest portion of the economy being the baby boomers, holding the largest share of the wealth. Everyone wants to live forever, and the amount of capital investment opportunities that's going to be in around health and wellness is going to continue to be dominant. So it's kind of one of the things, that I wanted to get through. I think a lot of this that's been going on and on and on has been about, sticking true, don't miss the good days, all of these superfluous kind of feel good moments. But I'm well aware, I've been doing this 20 years. The investor fatigue is real. The shiny lure of, getting a GIC or a money market rate versus that of taking it market risk. But I have to feel, and I don't know, I'm not a baseball player, but I did I was just down in Houston last week and ended up watching some baseball with an Astros fan. So I'll give you a baseball analogy. In all of this, guys, and I said this last talk, the economic cycle of news, and it's at its worst, is about the inflection point where things get better. So I don't know if it's the top of the seventh or the bottom of the seventh and where that seventh inning stretch lies. But the worst of this is far from over. Well positioned. We have a great amount of liquidity. We are following a seasonal pattern. I'm expecting, some stronger markets into the end of the year. I've never seen in my life cheaper small cap growth opportunities. Here's a great one. 1 year off the low is the small caps being up is the worst we've seen in 100 years. Recessionary fears have weighed heavily, and rising interest rates are more impactful because there's generally more leverage on the balance sheets. There's a lot of coiled springs and rocket ships. Doesn't mean while these things are on the tarmac, a lot of them are not going to blow up. There is always this hangover effect. In fact, that's some of the parts of the market that bother me the most, because when things turn and everything starts working, you still have a bunch of broken toys that just never got enough capital or attention, in the back of Santa's bag. And there will be some, call it, dead bodies in the back of this. So kind of on a go forward basis, I'm kind of open up the line is, our objective is to position client capital prudently, pragmatically, and effectively to construct portfolios that give the highest probability of achieving the stated goals over a market cycle. It's a mouthful, but given the results of last year where capital preservation was paramount, this year stripping back those magnificent seven, this is the sandbox that we're in right now. I just had a call with a great client. He's call it a specialist more than a generalist, and likes to get in the weeds with me and talk specifics on individual stocks and balance sheets and what the management's doing, et cetera, et cetera. And it's wonderful. And I try to always pull the conversation up to the top. But the point of it is, we can sit there and talk the fundamentals of a company's balance sheet and ability and prowess of their management, or their new product line, or the well that they're drilling, or the mine that they're bringing on production. Take all of that away and just go into a vacuum for a second and meditate. And there's no sound, there's no light. You're in a dark room, and you say, we've got a decoupling of globalization. We've got a multipolar world setting up. We've got geopolitical unrest. We've got wars on multiple continents right now. We've got the fastest spiking interest rates and an economy ram roaring towards a recession. That's the environment that the companies that we invest in have to operate in. The net reality of it is a turbulent skies. Some companies have punched above the clouds, but it's a tough environment. We've been through this. We will go through more. But the reality is sticking to your process, having great philosophy, and investing in quality people, because, ending it back to the psychology of money by Morgan Housel. It's a great book. As any of you want to call me and ask me a question on it, maybe you get a book out of the deal. But the most important part of every plan is planning on your plan not going to plan. And there's rarely more or less economic uncertainty. So we're doing our best to analyze, to take in all the variables, but ultimately the business cycle will chew through it, and we'll get to the other side. I hope you all have a wonderful month. As always, appreciate you all as clients. We care deeply and we work tirelessly to identifying opportunities and to mitigate risks. If there's any questions, comments you'd like to drill down into, feel free to give myself or any member of the team a call. And I look forward to talking to you all next month. Have a great day.